The market is wrong about Spotify stock. The stock price is down 20% year to date, but this drawdown could be a huge opportunity for long-term investors like us. Spotify recently reported strong earnings, leading the stock to jump 15% in a single day. But even a 15% jump couldn't save the stock. In today's video, we're going to analyze Spotify stock so you can gain a deeper understanding of the business. This should allow us to take advantage of this rare buying opportunity. And as a Spotify shareholder myself, I have skin in the game, but I want to bring you along for the ride. We'll cover Spotify's recent earnings to see how the underlying business is actually developing. We'll discuss the stock's current valuation towards the end, and I'll also tell you what I'm doing with my own position. This chart shows the year-to-date performance of the stocks on my watch list, and as you can see here, Spotify is one of the weakest performers. We can see by the names on the chart, a clear pattern is emerging. Software-related stocks like Intuit and Duolingo are being hammered, whilst companies with physical asset moats like TPL and ASML are outperforming the market. So it seems like the fear of AI, which has swept through the market, is resulting in money transferring from software stocks into companies with more tangible moats. Software companies generally don't have any real-world physical advantages. Their moat is in switching costs, distribution, and network effects. The market believes these are more susceptible to AI disruption, whereas companies like TPL own huge swathes of land in the Permian Basin, which is used to produce oil royalties. This is the type of business that AI can't disrupt and may actually benefit from the power demand created by AI. So now let's get into the actual analysis. We're going to look at Spotify's earnings call summary on Qualtrim. It provides a concise breakdown of what management actually said about the business during the last quarterly call. The first thing to note is the leadership transition. Founder and CEO Daniel Ek is stepping down after 20 years at the helm. He'll still be involved in guiding the company as executive chairman, but won't be as involved in the day-to-day running of things. The new leadership structure will have two CEOs, Alex Norström and Gustav Soderstrom, who are long-time internal leaders who helped drive mobile, subscription, machine learning, podcasts, audiobooks, and marketplace. Management believes good planning becomes even more critical in the AI era to fully utilize productivity gains from AI tools. Spotify's management then discussed the company's strategic positioning and long-term philosophy. They say, core strategic lens remains solve problems at the intersection of consumers and creators, where both sides benefit, e.g., Discover Weekly, Wrapped, Spotify for Artists, new mobile free tier. So they're basically reinforcing the importance of their network effect, making sure that both consumers and artists benefit from Spotify's platform more over time, helping to lock users into their ecosystem, which strengthens the business overall. They note that Spotify positions itself as a technology company and R&D arm for the music industry, with ambitions now extending across audio and broader media, music, podcasts, audiobooks, video, live, and more. This is important. Most people just look at Spotify and see an app, but as long-term investors, we need to look a little deeper. Management mentions Spotify's role as the R&D arm for the music industry, and we can see this in the numbers. Spotify spent $1.65 billion on R&D in the past 12 months. Importantly, you can see the pattern of spending actually stabilizing, even decreasing over time. This shows the company's operating leverage, which is essentially its ability to cut costs and increase profit margins. This contrasts with the traditional big tech companies who are ramping up capex spending on AI investments. I have to stress that this operating leverage, the ability for Spotify to control spending, can unlock huge shareholder value, especially when the stock is undervalued like today. Spotify can lower costs and produce extra free cash flow to return to shareholders via buybacks, although at the moment the company is a net issuer of shares rather than a buyback machine. This is disappointing, but if we look at Spotify's free cash flow, we can see it's growing rapidly over time, and the company is currently sitting on $11 billion in cash, which could be deployed into buybacks at some point in the future. Back to the transcript. Management reiterates a play the long game approach. Growth was prioritized over profitability for many years to build scale. Now the focus is on balancing growth, innovation, and margin expansion. This is what I like to hear. As long-term investors, we want to know that the companies we invest in have management teams that also share that same vision. This also implies that growth will be slower in the future, which is probably why the company's valuation has become cheaper, going from a free cash flow yield of 2% to 4%. A higher free cash flow yield means the stock is cheaper. In this chart, we can see the revenue growth trend over time. The growth rate has fallen in cycles from 30% down to 20%, now down to 9.4% in the past 12 months. It's important that revenue does continue to grow at around 10%. This should support underlying free cash flow per share growth of at least 15%, which is the bare minimum I expect for a company I'd invest in. We can see from this chart that Spotify has grown free cash flow per share at 28% over the past 12 months. I expect this growth to stabilize at around 15 to 20%. You might be thinking, well, where is this growth going to come from? Good question. If we look back at the earnings transcript, the next segment discusses Spotify's growth. Q4 2025 delivered record monthly active user net additions, taking Spotify to serving over 750 million people globally. Wrapped 2025 was a major driver. Over 300 million users engaged, up 20%. 630 million social media shares, up 42%. And day one of Wrapped was the single biggest subscriber intake day in company history. If you don't already know, Spotify Wrapped is their main marketing campaign, which is disguised as an opportunity for users to socially signal to friends and family. Wrapped shows you data about your listening habits. For example, which artists you listen to most. Out of that artist's fan base, which percentile were you in? Meaning, were you in the top 1% of listeners? Every year, my social media is full of this stuff. My friends and family showing off their stats like a badge of honor. And it's always Spotify Wrapped that people share. Competitors like Apple Music do the exact same thing, but no one seems to care. That shows you qualitatively the advantage that Spotify has. Their users have been programmed to promote the company in the name of gaining social status for themselves. Engagement across more days, more devices, and more content verticals, music, podcasts, audiobooks, is treated as the key leading indicator for churn, revenue, and lifetime value. Management described their flywheel, basically how the company continues to grow. They say monthly active user growth equals more engagement and retention, which equals more revenue, which equals more value returned to creators and partners. So that means like the artists. That means more innovation and content, and that equals further growth. Next, we've got management's commentary on the company's financial performance and outlook for the future. I'm not going to bore you with the performance because that's already happened. What I want to focus on is the future. What is management's outlook? Management expects both gross margin and operating margin to improve further in 2026. Though quarterly progression may be variable due to the timing of disciplined investments. You can see the trend of Spotify's operating and gross margins over the past 10 years. As the companies become larger and stronger, profitability has continued to increase. Management expects this trend to continue. Free cash flow generation is expected to meaningfully exceed 2025 levels while moving towards a more normalized long-term tax rate. Looking at this chart of Spotify's free cash flow, you can see that 2025's free cash flow exceeded $3 billion. Now let's move on to the juicy part. Spotify's monetization, pricing, and average revenue per user. Management says the company has multiple growth levers: pricing, user growth, product innovation, and improved monetization with subscription and ads. Recent US premium price increase of $1 in January 2026 is similar in magnitude to the June 2024 increase. Churn so far is low and in line with expectations. Management's mention of low churn, the rate at which subscribers cancel their subscription since the recent price increase, is promising. It indicates Spotify has much stronger pricing power than many investors thought. They note pricing is managed on a market-by-market basis. The stated goal is always to deliver more value than price and to adjust prices from a position of strength. This is the philosophy that many subscription businesses use to dictate pricing. Delivering more value than price keeps pricing sustainable and churn low. They also say ARPU is set to accelerate in 2026 with 5 to 6% year-over-year growth in Q1. With price increases expected to contribute to margin expansion as revenue growth is expected to outpace net content cost growth. This is promising stuff. It sounds like revenue growth could be about to reaccelerate. Any reacceleration of revenue growth should send Spotify's valuation higher. Speaking of valuation, I think now's a good time to look at it more closely. Spotify currently trades at around a 3.5% free cash flow yield, which is pretty reasonable and may even look cheap if growth does indeed reaccelerate. You can see from this chart that over the past year, the free cash flow yield of Spotify stock has fluctuated from as low as 1.8% to as high as 3.8%. So it's currently near the sort of cheaper end of the spectrum. Let's hop over to the DCF calculator on Qualtrim to determine the potential return of Spotify stock if you were to buy at today's price. We have to make assumptions of Spotify's free cash flow per share growth over the next 5 years, and the free cash flow yield we expect the stock to trade at. I think it's reasonable to assume that free cash flow per share will grow at a minimum of 15%. This is lower growth than Spotify has historically produced, and like I mentioned, I expect growth to re-accelerate. But we'll use 15% just to remain conservative and not get carried away with it. And then in terms of free cash flow yield, I'd expect Spotify to trade at around a 3% yield long term. These quite reasonable assumptions produce a shocking outcome. With these assumptions, Spotify stock could compound at more than 18% over the next 5 years, meaning the stock would grow from around $490 per share today to over $1,100 per share in 2031. That's why I'm betting big on Spotify stock in my own portfolio. I currently hold around $440 worth of Spotify stock, and I'm down around 11.5%, or about $50 or $60 on the position. Despite this, I'm bullish on the stock long term. I think the business model is awesome. It's the clear market leader with a massive user base. I myself have a Spotify subscription. It just goes to show that sometimes the best investments are the companies that you interact with every day. If you enjoyed this video, give it a like, subscribe to the channel so that you don't miss the next one. Also, click the next video for more.